Hello, my fellow traders. This is Mohiith Shankar, a SEBI registered research analyst and an educator. So, you have known, if you have clicked this video, I understand that you have not been able to make the money consistently as most of our traders do. Now, the reason behind is not that you don't have an access to all the tools which you have, right? There are almost like about 50 to 60 indicators, but which one to use and which one not to use, or what is the right combination to be used. So, in this video, we would be discussing about the 5 most simple and yet powerful indicators which you can use for intraday trading. All my videos would be more focused towards the intraday trading, but however, you can change certain conditions and you can make it compatible even for the long term as well as the positional trading as well. Right? So these are the 5 simple and yet powerful tools which I'll be telling you to you. So please stay put with this video till the end so that you can take in all the knowledge which we are going to learn together. Understand, trading is not about prediction but about probability, discipline and execution. Let's start this video. So 5 best indicators which I'm going to talk to you about is, first, if you know about my channel or if you're being my subscriber or a viewer, you know that I always use Hikanashi candles. Why is this better than a normal candle? We will try to understand this. Exponential moving average, what is the right combination to be used? What is the entry? Or probably what is the exit? We will try to understand with practical examples. Relative strength index, do you buy above 70 or do you short below 30, or do you just buy in the overbought zone or don't sell in oversold zone? What are the key levels to watch for? We will understand today. Volume weighted average price, how does the big institutions decide to buy and when they decide to dump a particular stock? Let us understand this. And Bollinger Bands. Now, what is the Bollinger Band? What is the standard deviation? Where do we buy? Where do we exit? Are these all give the entry signals or is just the confirmatory signals? What are the combination which we can use by adding all these 5? That we are going to learn in this video. First, we would understand the difference between a normal candle and a Hikanashi candle. Now, if you have been watching my daily videos on Nifty analysis, wherein we post the daily strategies, what we use, we try to learn each strategy or the flaws or where did we go, where did we make mistake or what did we learn, because every day is a learning process when it comes to trading. So if you don't know that, I usually use the Hikanashi candle. Now, this is a Hikanashi candle. If you are going here, see here, top left, let me put a normal candle. Now the normal candle, if you can see here, there is a lot of noise. The Hikanashi, what it helps is it helps to cut the noise, because as a trader the market will not move in one single direction. There will be ups as well as downs. Now this is the normal candle. Obviously you see here there is a confusion. Every other candle is a red and the other candle is a green, but you don't know where the markets are headed. So let me shift this, change this to Hikanashi. So Hikanashi is a Japanese word. So see this, here we see that the market, there is a downfall and now there is an uptick. In fact, even if you see here, all the noise, most of the noise is cut by Hikanashi candle. It takes the average of the prices and plots it on a graph. That's the reason I prefer Hikanashi. Now what does this mean? Say suppose here, the lower, there is no lower wick here. If you can see, let me zoom in this one for you. There is no lower shadow or the lower wick. It means there is a bullish momentum. All right. And if there is no upper wick, it means there is a negative or a bearish momentum. All right. So Hikanashi, if you are using a normal candle, just try to switch it to Hikanashi. You would understand the difference. Now, why do we use this? This is simply to reduce the noise. All right, and to understand whether the market is bullish on an average, is it bullish overall or is it bearish? Exponential moving average. Now you might know that there are various combinations you could use when you are adding the exponential moving average. The commonly used combination is 9 and 21. Now what is 9 and 21? It indicates the period. Now why do I say period? The period depends upon the chart time, whatever you have put. Now in our example, I am taking 5-minute chart because usually either you choose 5-minute or 10-minute or 15-minute if you are an intraday trader. The focus on most of my videos is for intraday traders. However, you could use this chart for positional trading as well. Now what do you do in case of positional trading? Instead of 5-minute or 10-minute chart, you just change that chart into 1-day chart or a 1-week chart similarly. All right, so 9 and 21 is the most important combination which we'll be using, although you can customize the combination and see which works better for you. For me personally, 9 and 21 works. There are people who use 20 and 50 as well, or any other combination of your liking. All right, so 9 and 21. Now what does this say in case of an exponential moving average is that in case of a 9 and 21, see, 9 is a fast, it is called as a fast exponential moving average, and 21 is a slow. When I use a combination of 25 and 50, this becomes fast and this becomes slow moving average. Comparatively, it's relative. So 25 becomes fast and 50 becomes slow. Similarly, if I use 9 and 21, 9 becomes fast moving average, 21 becomes slow moving average. Now say, let me represent 9 by a straight line and let me represent 21 by a dotted line. This is just for an illustration purpose. I will anyways explain it to you on the real chart. Now what is happening here? So this dotted is 21 and straight is 9. Whenever the fast moving average crosses and is above the slow moving average, it gives a buy signal. All right, vice versa, whenever the opposite rule is, or the vice versa rule is, whenever the slow moving average, in our case it is 21, is above this fast moving average of 9 period, it's not days, 9 period. A period depends upon whatever time frame you have chosen. As I have told you, this indicates a bearish signal. All right, now this exponential moving average you can also use, or any of the indicators what I'm telling you, you can also use with the other indicators. This is effectively used with volume weighted average price, which we will be learning it next. So let us understand this on a real TradingView app. So here I go to the TradingView app, or any of the app whatever you are using, you could use that provided by the broker. Now what do I write is exponential moving average. Now understand, when moving average exponential, you click this twice. All right, so now one is 9, it's already giving you a default setting, and now let us change the setting of the another. You just put 21. All right, and for a better smoothing line also you can put it as 21. Now we need to have a clear distinction between fast and a slow moving line. Preferably I like to use a slow moving line as red, because that's an indication that it's a selling momentum. So I have highlighted this. You can choose the thickness of the arrow line here. So this is how it looks. Now let me change the visibility of a fast moving line as well. Only thing I'm going to change is just the thickness of this. Okay, now what you see here is the fast moving line, which is blue line, is crossing the red moving line. Fine. Now what do? You wait for the confirmation. Ideally what you do is you wait at least for 3 candles. Now let me show it to you here. See here, at least you wait for 3 candles, because there are chances that it might fall back. You don't want to take a position when the momentum or when the movement is not, the direction is not confirmed. Usually I would not say the thumb rule, but this is what I have been doing. Whenever it crosses, you wait for 3rd candle and then take a trade. All right, now what should be your stop loss? The stop loss, again, that is a separate session. We'll be taking it the next week. So enter in here. All right, so this indicates the direction. Now what happens, let me show you the short. It has cut here. All right, it has cut here. You wait for 3 candles, 1 2 3. 3rd candle, you have got a good price. It has, there is an uptick here. You can short here. All right, you short here, and then probably it wouldn't have hit your stop loss. Hardly 4 points. If you can see here, 24,995, 993 and 25,000. It hasn't hit your stop loss yet. You go with the trend. That is, you are short in this market because the 21 day moving average, 21 period moving average is above the 9 period moving average. You stay short in the market to make the money. Your target should be whatever you have pre-decided before taking a trade. Your target should not be dictated by the once you are into the trade already. Your target should be pre-decided, as well as your stop loss should be pre-decided. So these are the flaws which happens, but I will talk about this in my next video or a separate video. So exponential moving average is another very good indicator which you could use in your daily trades. important, but yeah, this is in any combination you can prioritize one indicator over the other, is the volume weighted average price. Now volume weighted average price, I would also like to say, this is an institutional buying and a support zone. Now what happens is that this is usually used by mutual fund houses or big institutions. Average price, when you plot it on a graph, it gives you an average price. Suppose you have a candle here, here and here. What it indicates is that if this is the volume weighted average price, all right, and the price is above this line, you make all buying trades, you stay long in the market. All right, this is not an entry, this is not an entry indicator, this is just the confirmation of the trend. All right, if the price is below this line, if the price of the current day's price is below this line, it's a bearish call, the bearish momentum. So you might think of shorting the market, or if you're already short, continuing staying short in the market. All right, so this is a price, as I told you, VWAP, the price is above VWAP, is a bullish bias, and if it is below, it is a negative bias. Institutions and algos use this VWAP. Now what is the best way is mix this, use a combination of VWAP along with the exponential moving average indicator, which gives, it's a confirm, one gives an indication, the other to enter the trade, the other gives a confirmation to stay long for a longer time. These are the two strategies you can use in combination along with the Hikinashi, of course. So let us plot this, use this on a graph and see in the trading view and see how it actually shows the signal. Here, what you see here is a trading account. All right, this is Angel, because the in trading view was not giving me the clear visibility of VWAP. Don't know for what reason. Now I have already gone to FX indicator and put VWAP. You can see here. All right, you can change the visibility to however you want. Now if the price is above this line, it's an indication that there is a bullish momentum which is continuing, there is at least no short. Now if the price is below, it indicates that there is a bearish momentum. All right, probably you might have to take a trading call on the lower hand side. Okay, so what you can do is use this in combination, or try to check this for few days before implementing it. That's the best way to implement any new strategy. Them would be familiar with relative strength index. It's a very simple rule. What happens is that the RSI varies between 0 to 100. All right, so this is 70 and this is 30. The detailed description video of RSI, I will be posting it later in my educational basic to advanced educational series. You can go and check that. I think I've already posted it as well in my very old videos, but I would be making a new video very soon. Now what happens is that the relative strength index, imagine if the movement is, this is an oscillator. Okay, oscillator, typically why do we call anything as an oscillator? Because it oscillates between one point to another. Now it oscillates between 0 and 100. That's the reason these are called as oscillators. Now there are many indicators, many oscillators. If you start implementing everything, or if you start noticing everything and trying to implement on in your day-to-day trading, it becomes a paralysis. What we commonly say is analysis leads to paralysis. All right, so don't let that happen. All the strategies should be I don't know who said this, but yeah, whatever strategy you make, it can be written in one small postcard size paper. Then your strategy is right. Keeping it simple is the key. Now what happens in an RSI? If it goes above 70, it's an overbought zone. Probably the price might reverse back, it might come back. All right, this is 30, when the price is below 30, it is an oversold zone. Probably you might not want to take a fresh short here. Now how do you take a trade in an intraday? If it breaches this and shows an upward momentum, probably this might be your buying point. If it cuts 70 and tends to go down with strong momentum, this might be your shorting point. Now one more important thing is divergence, which is important when it comes to intraday trading. All right, this I have already told you. So what is a divergence? For example, see here, I will show you the RSI. So this is 70, this is 30, this is 100, and this is 0. Can we change it to 20 and 80? You can. It's customizable. You can choose any of the bands according to your experience and whatever signals it is giving you. All right, so 30 and 70, because 20 and 80 there'll be more fall signals, chances of fall signals will be more. That's the reason we usually keep it to 30 and 70. If you're an aggressive trader, probably you can shift to 20 and 80 as well. 30 and 70 is what I keep. So what happens is that, imagine, okay, now the price is 24,500. I'm just taking the example of Nifty. 24,500, the RSI is here. All right, now after half an hour or 1 hour or so, the price becomes 24,550, but the RSI has not made a fresh high. So this is a negative divergence. What it means here, the price is increasing, but the RSI is decreasing. A negative bearish divergence, probably it's giving you an early sell signal. Similarly, when the RSI is here, it has made a fresh low here. Imagine 24,300. Okay, now the market makes 24,200. All right, but still the RSI is above this lower point. There is a positive divergence or a bullish divergence. So the price is falling, but the RSI is increasing, or it hasn't made a fresh low. This is when probably you might check for a buying signal. Probably the market may reverse from here. Alright, this is a divergence strategy which I use very regularly in my day-to-day trading activity. Even if you are like a positional trader, you could use this. Now let us understand this in a trading view chart. And the last one would be the Bollinger Bands. This is the fifth indicator which I would be showing it to you. A Bollinger Band, as the name suggests, it's a band. Alright, this is an upper limit and this is a lower limit. Okay, this is the average of 20-day period. Now should it be a 20 period, or can I change this? You can customize it according to your trading methodology. Now 20-day period. Now what happens is that, say if the price is here, if I'm plotting the price here, if it comes near the upper end of the band, you might see it falling back towards the median. You might see falling, this is the mean. Okay, usually what happens is that the Bollinger Bands are made +2 standard deviation and -2 standard deviation. They are constructed like this. So now in this video I would not be explaining it to you in detail how we construct the Bollinger Bands, but for you to understand, a Bollinger Bands has three things you need to notice. One is an upper limit, lower limit. Second is the median, which is 20-day, and the third is the 2 standard deviation on either side. Can you change the standard deviation to 3, 4? Yes, you can. Noise gets reduced, so as the number of entries into the market. A Bollinger Band it's only a confirmatory signal. You can't take it as an entry or an exit. Whenever the price, say imagine it comes to the lower end of the range, there is a high probability of it moving back to the median average price. So that's how you take a call. All right, now let us understand this in the chart. If you just put Bollinger, you would get the Bollinger Band. By default it would take about, let me show you here, 20-day and a 2 standard deviation. Right, you can go and check in the visibility, or you can go in the inputs and you can see this is 2 standard deviation, 20 length. All right, now whenever the price moves here, the probability of it coming back to the mean is more. Whenever the price comes here, it is more. Now how do we use, whenever there is a narrowing of the band like this, it has happened, it can go on either side. It can either expand on the lower side or it can expand on the higher end. The breakout can happen. That's where it gives a clear signal. Now see this one, there is a narrow range, narrow band, then there was a breakout happened on the higher end. That's when you take a call. Understand, now we have understood the 5 indicators or oscillators. How do we use this? Now volume weighted average price plus the exponential moving average, you can use it for a trend confirmation. RSI and Bollinger reversal spotting, as I have told you. Hikinashi, it cuts the noise, simply cuts the noise. All right, now summary, I will just summarize this, whatever we have learned. The volume weighted average price, it's an institutional resistance and support zones. Okay, if the price is above this, you buy or be bullish about the market. If the price is below this line, average price, you remain bearish. RSI, you understand how do we use this, 70-30, but most importantly check for the divergences, a positive divergence and a negative divergence. All right, this is not an entry signal. Understand, RSI is not an entry signal, and volume weighted average price is a confirmatory signal. RSI is also a confirmatory signal, although it indicates that okay fine, the market might change, but exponential moving average is more for our entry. Always wait for the third candle after the crossover. This, make it as a rule, third candle after crossover. Bollinger, it gives a signal whether if there is a narrow band, there might be a breakout, or else if the price is at the higher end of the band, it might come back to the median. Hikinashi, smooth trend, there is no noise. Alright, so we have completed all the most 5 important indicators which you must be knowing whether you are a beginner or an expert trader. So the most important rule of trading is to play great defense, not great offense. So if you found value in this session, don't forget to like this video, subscribe to the channel and hit the bell notification so that we get actionable trading insights every week.